My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So if you find that interesting, then please consider liking this video and subscribing to my channel so you see more analysis. Super interesting video today, controversial video even, about one of the most talked about companies on the market and in the world, Tesla Inc., ticker TSLA. Today, we're going to deep dive into the company, discuss its market position, take a look at the financials, and discuss the risks. And finally, I will give it a grade. Buy, sell, or hold. Um, just some gentle foreshadowing here. I am not a Tesla bull, and I'm going to explain why. A couple things to note. Yes, I did shave for the first time in a while. For the first time in any of my videos, in fact, you're seeing what my baby face does look like. My wife referred to me as the naked mole rat. I will take that as a compliment in stride. Thank you. Another thing, I use Seeking Alpha. As you know, if you've seen my videos before, you see it here. Not only do I contribute analysis to Seeking Alpha, but I utilize it heavily in these videos. Well, now I am giving my audience the opportunity to get Seeking Alpha at a roughly 10% discount. And you'll see that link in the description and in the pinned comment below this video. So let's talk about Tesla. First off, none of my videos are financial advice and do not constitute a recommendation to buy or sell a security. However, this particular stock here, this is one of my most loathed stocks. I do not have a position in the stock. I do not plan to enter into a position in the stock. And today, my goal is to lay out not necessarily the bear case for the stock, but why I believe that it is a poor investment vehicle. And yesterday I was discussing with my wife. Shout out to my wife. I was discussing with her uh, my content, and she gave me, some feedback. She was like, "Why don't you make videos and analyze things that you don't like? Because it seems like a lot of what you analyze is what you do like." And she's absolutely correct in that. Here's the reason that I don't like to be a doom and gloom bear and discuss things that I don't like. The main reason is because you can a stock can be objectively overvalued in a bad, like the fundamentals can be, in your opinion as an analyst, they can be very poor and not make sense, but that stock can still perform very well. Tesla, of course, over the last 5 years, we see up 735%. Over the last 10 years, 1,800%, and all time, almost 20,000%. So obviously, the stock has performed very well. My opinion about the company has been the same since roughly this period, 2018. I've never posted about it or made my analysis public until now. Obviously, that roughly corresponds to like what, from this point here, a 12x. Does it make sense what I'm trying to say? Hopefully, you don't have to invest in things that have good fundamentals to make money in the stock market. I think we all understand that because stock prices are driven by sentiment. However, I do want to discuss this stock because it is so visible. I feel like I can contribute a useful viewpoint to the discourse here about the stock. So, what is Tesla? It's an electric car manufacturer. Now, so much of the discourse about this company is that it's an AI company, that it's a robotics company, that it's an energy company, that it's this, that it's that, that it's what not. But it's a car company, guys. It's a car company. Um, and I think we have to be objective about where it is today while being cognizant of where it could be in the future. I think Tesla, more than any other company in existence today on the stock market that I'm aware of, um, Tesla has it trades with more hype and more just furious speculation than any other company. And that is because the CEO of the company, Elon Musk, is very, very good at marketing. Okay. And I don't, you know, he's been in the news lately for political reasons. I don't introduce political analysis into my commentary, but regardless of your political opinions about Elon Musk, I think you have to give credit where credit is due in that his ability to market his companies and not just marketing, but actual results is very strong. But I do think that Tesla is a company with a cult like following and cult like personality. You see this reflected when people like Kathy Wood give these insane, like several $1,000 price targets on the stock. I mean, just insane stuff. You see here the market cap, $800 billion market cap for this company. Okay. So I'm not going to go too deep into what this company is because I'm going to make an assumption that if you're watching this video, you understand what Tesla is. One thing I do want to talk about is the sentiment driving the stock. Now you see here, there was what's happening in this period. Obviously, here you have COVID mania. The stock performed really poorly, actually, in more of the bear period here. Um, when the broader market at large performed poorly, given that it's one of the top 10 biggest companies in the market, it is driving a lot of the gains in the index. But what's going on here, guys? Well, I think that's pretty easy to understand. You have Elon hitches himself to Donald Trump and his candidacy for president, and then Donald Trump wins. Donald Trump wins the election. What is that? November 5th, right? So the price was $251 or November 11th. Either way, clearly I'm not a political pundit. Either way, roughly correspondent with the time of the election to the end of the year, roughly it peaked at $480 a share. So you see, you see the mania that it surrounds this stock. It bid up because of a political affiliation. I would argue that, right? Also, let's talk about it was $480 a share. It's up $6 a share. So it sold off more than half, okay, since that time. In 3 months, it sold off half, okay? Insane levels of volatility, all right? If you're gonna play this game, you got to not lose your ass, okay? And that so right off the bat, I want to discuss how this uh, this stock, has insane levels of volatility. You see here, it peaked at $400 a share, traded all the way down to 100. That's a 75% drawdown, back up to 300, back down to 150. Very, very common for this stock to have 50% drawdowns or more about once a year. Okay. On average, at least over the last 5 years. Whereas we saw here, pretty good run, went from 20 something bucks to 400, so almost a 20x. But even then, from 300 to 200, so that's a 30% drawdown in the midst of that. bullish phase. So I want this analysis to be grounded in fundamentals purely. Okay, so let's start by taking a look at what it means to be in the auto manufacturing business. Now we see here, using this screener here on Seeking Alpha, there are 28 companies publicly traded in the universe of automobile manufacturers. Okay, let's take a look at the market cap. Okay, let's take a look at the market cap. Tesla, by far, is the largest auto manufacturer in the world by market cap. In fact, it's over 3 times the size of the next biggest, which would be Toyota. Okay. Next is BYD. Pretty important. Pretty important here. BYD. Interestingly, we then have Ferrari, then Mercedes-Benz Group, Volkswagen, Porsche, General Motors, Honda, Ford, Stellantis. I want to pause here and I want to disclose that there are a few types of stocks that I really just refuse to invest in. One of those is automobile manufacturers. Okay. They are, in my opinion, some of the worst businesses to invest in. And the reason for that is they basically violate all of the criteria that I want to see when it comes to an investment in a company. If you've watched my videos before, you know what I like. What I like is recession resistant properties and recurring revenues. Okay. Strong recurring revenue profiles. Okay. Recession resistant properties are weighted much more highly than the recurring revenue piece. Um, Ideally, our businesses also aren't super capital intensive. And if they are capital intensive, then there's a very strong and immediately easily calculable ROI on that growth capex. For example, yesterday I covered Prologis, a real estate investment trust. In fact, the largest real estate investment trust. Um, I own Prologis. I like the stock. I gave it a buy rating. Investing money, it's capital intensive to invest in real estate, right? But very easy to calculate within a certain band of uncertainty what your return will likely be when you outlay capital. um, Automobile manufacturers are cyclical. Automobiles are discretionary spending, despite this idea everybody in our a lot of people in our nation need a vehicle. I think there's an argument either way. However, um, automobiles, I would say they're discretionary primarily. um, Automobile sales are subject to interest rate risks. They're sensitive to interest rate fluctuations, just like real estate, but they're depreciating assets that are not easily monetizable for the end customer. Whereas, if you buy a house, you can rent it out, whatever. So um, let's take a look. Again, you see the majority of automobile manufacturers are not very big. Okay, we only have 3 automobile manufacturers with a market capitalization greater than 100 billion. Toyota is one of the most recognizable brands in the world, right? Well, PepsiCo has a market cap similar to that, right? Automobile manufacturing, it's so visible, it's so everywhere, it's so political. Yet these businesses are crappy businesses for the shareholders, in my opinion. Okay. So, okay, right off the bat, we see how by market cap here, Tesla is far and away, the largest automobile manufacturer. Let's just take a look at some comparable data here. Price earnings on a trailing 12 basis, I assume that's gap. 118 times earnings. 118 times earnings. 87 times forward earnings. Let's compare that to Toyota. You can buy Toyota for less than 8 times. BYD, very formidable challenger to Tesla in certain markets like China, trailing at 28 times with price earnings growth of 1.5 times on a trailing 12. You see Toyota less than 1 times price sales, whereas Tesla 8 times price sales. Are you kidding me? 57 times enterprise value over EBITDA, 10 times price book, price cash flow, 52 times. In fact, if we look at the entire universe of these companies, what do you notice? Let's just focus on this column for now. All of our established automakers, Toyota, this is Ferrari. Okay, this is Mercedes, 6 times earnings. Volkswagen, 5.25 times earnings. This is Porsche, I think, 14 times, not a little bit more. GM, 7.5. Honda, 7. Ford, 6.5. Stellantis, which is Dodge, Jeep, Chrysler, and others, 6.4 times. I think some of these other tickers are, ones and then you see all these other, there are no price earnings. You've got kind of some other EV makers like Rivian is here, Lucid. Those don't have a price earnings multiple because they're not profitable. Okay. So the market generally tends to agree with me when it comes to auto manufacturers that they're crappy businesses that deserve to trade at low multiples. If you're okay with that, something like Stellantis, you could, the dividend yield on a trailing basis, I believe that is what it is, 14% yields. Very common to see established automakers paying between a 3 and double digit percent dividend yield. Most of these valuations are very strong valuations for buyers. I think it might be an important call, but they can wait. This is important. Just talking about Tesla is important. So the sheer gap in size and valuation and scope between Tesla and these other companies right off the bat, that's a huge red flag. I mean, you see Ferrari here trades at pretty absurd valuations, more expensive in some areas than Tesla. Why that is, I'm not sure. I got to be honest with you. I've never looked at Ferrari. Never looked at Ferrari. Maybe I will later. So yeah, the relative valuation of Tesla, if we're just apples to apples talking about auto manufacturing, is insane to me. And I know that there's lots of people in the market that would agree with me. And now I want to dive into relative numbers versus the other Mag 7 stocks. Okay. So, first, I want to take a look at on this chart several objective measures of how Tesla compares and how it's different from the other companies. And what I think you'll find together is a support of my thesis. So let's start here. So we've got each of the Magnificent Seven stocks: Apple, Facebook, Amazon, Google, Nvidia, Microsoft, and Tesla. And sorry, not Facebook, Meta. So this chart here is EBITDA, earnings before interest, taxes, depreciation, and amortization in the trailing 12. What do you notice? Pretty simple to see what's going on. Okay. All of the Mag 7 stocks starting in mid 2023 just start crushing earnings. And furthermore, been in a strong upward trend this entire time. At one point in time, Apple, then Microsoft were the biggest. All of these stocks, with the exception of Nvidia and Tesla, had very strong, consistent growth up to here, went into a slight bear market here. But then Nvidia started to go bazonkers. You see here, Nvidia is the purple. Tesla is the orange, and kind of closely matched the whole time. Tesla's been at the bottom of the heap in terms of EBITDA, or really profit for free cash flow. Really been at the bottom of the heap of all these stocks over, this is a 10-year time frame, by the way. But the trend is the same over 5 years, 3 years. It's been near the bottom. The only exception is that Tesla has not increased its EBITDA as of late. It's been flat. It's even come down a little bit. Meanwhile, all these other stocks have soared. Okay, that's EBITDA. Let's take a look at something else. Let's take a look at margins, gross margins. Okay, what do we see here? Gross profit margins. Tesla, again, by far the lowest gross profit margins. The next lowest as of today is Apple, 46%. So that's almost 30 points more than Tesla. Another thing is, probably with the exception of NVIDIA, all of these other stocks, with the exception of NVIDIA and what is this, Microsoft at the top here, Meta, gross profit margins have been stable or going up. Meta came down slightly. It's not a tech company, folks. It's an automaker. These are margins that you would see in autos, okay? So much of the future diversification away from autos is being priced in, and there's lots of downside risk with that, in my opinion. So again, Tesla at the bottom of the barrel. Why don't we look at free cash flow per share? This is a little bit more tight. Meta having more volatile but more pronounced growth in terms of free cash flow. But as of today, Tesla at the bottom of the barrel. That's actually probably not a good metric just because their share prices are so different. We would instead want to look at free cash flow margin. Let's look at net income margin. Okay. Again, as of now, Tesla has the lowest net margins, lower than Amazon even. And Amazon is a business that is notorious for having low margins. In fact, you see here several periods here, Amazon being the red. Several periods, Amazon has had single-digit margins for a long time, which makes sense. All of these companies have been consistently profitable on a net income basis for the extent of the last 10 years, with the exception of Tesla and Amazon. However, Amazon is a much different business. They're a retailer, and retailers have very low margins. Look at any retailer, and you will see that that is true. Okay, again, Tesla, in my opinion, far and away the worst margin profile. Let's take a look at market cap. Again, out of the metrics we've looked at so far, Tesla has had the worst numbers. It's the only company actually out of the Mag 7 that does not have $1 trillion market cap. But you see here for several periods throughout history, Tesla's market cap has not been the smallest, despite having inferior metrics, as we witnessed. Let's take a look at dividends. Again, only Apple, Meta, now Google, NVIDIA, and Microsoft pay dividends out of this bunch. So Amazon and Tesla do not. So again, it's a loser dividends wise. Let's look at valuation. We'll just look at PE gap on a backward basis. It's the best metric probably we can look at. Maybe we look at price cash flow next. Here's when Tesla actually started breaking a profit. So let's zoom out. Amazon wasn't making a profit here from these points. NVIDIA, very expensive until they hit this growth phase. Just to illustrate, in terms of price earnings, Tesla is by far the most expensive out of the Mag 7. And it's not particularly close. I think Google is the lowest for sure. Let's look at price cash flow. I don't know how Seeking Alpha measures cash flow here, but again, by that metric, it is also the most expensive. But you see Google, Amazon, Meta, all below 20 times. Meanwhile, Tesla over 50 times. What else can we look at? Revenue growth. That However, they're calculating that is not applicable. Why don't we look at this to kind of see the trend? So you see here again, earnings per share, Meta, very clear upward trend. Meanwhile, Tesla saw some momentum, but now again, the lowest earnings per share. However, you see here, NVIDIA 294 a share, Tesla 204. NVIDIA is what, 120, 115 bucks a share? It's less than half of the just dollar amount to buy one share. There was another thing that was in my mind. Let's look at the performance. NVIDIA should be the standout here. So this is really, really illustrative here. NVIDIA has been the top performer, followed by Tesla. Why has Tesla been such a strong performer over this 5-year time frame? It's a little perplexing after looking at the comparative metrics there. And then furthermore, in the 3-year time frame, it has been the worst performer. You have NVIDIA up over 4x, other stocks like Meta up 2 times. Meanwhile, Tesla's gone nowhere in 3 years. But coincidentally, it's actually the best performer over 1 year. And you see here what happened to it after the election. I mean, that you see the mania that this stock trades on. It's just crazy, in my opinion. I'm trying to think if there's anything else. If there's anything else relevant, maybe if instead we just look at revenues. We look at revenues here. Yeah, that's not a good chart. It's hard to get the relative numbers there. Okay, well, I guess we'll conclude it at that. I think again the most striking deal here is when you look at gross profit and how Tesla's gross profit has gone down over time, and that's requisite with what we saw in the deck provided by the company, gross profit margin, and then also the EBITDA. So you can't have both of those in the graph at the same time. So yeah, that when you compare the company to its contemporaries, these Mag 7 stocks, which in a lot of ways they're grouped together because of their performance. A company doesn't become a Mag 7 stock without outperforming at some point, right? So they're not like cherry picked out of the bunch. It's more that it's a reinforced mechanism created by market performance. So there is that. But with as a comparison, I just don't know how you justify Tesla being a value versus literally any of those other companies. And I have my own opinions about which of the Mag 7 stocks is the best right now. In fact, if that's something that you're interested in hearing my opinion on, comment that below and perhaps I'll make a video about that. But yeah, it's kind of striking to see the gap between Tesla and the other companies. It clearly has different drivers to the price that are much more untethered in the fundamentals. So yeah, it just further reinforces my case that when you're making an investment in Tesla, you're attaching yourself to manic speculation. You could do well, you could make money. You certainly would have over the last few years, but think about where that's coming from. Okay, the counterpoint to this is, well, what about all the other things that Tesla's doing? The technology, the software, the full self-driving, the robo-taxi potential with that, the robotics potential, the energy business, the ownership of the supply chain, the insulation from the tariff risk, all that. Okay, those are all legitimate reasons, depending on their market share growth, all that. Those are all legitimate reasons why the company might be justified in trading at a higher valuation than other auto manufacturers. Sure. But then it's incumbent upon us as investors to evaluate such upside. So I'm going to take a look here. Well, first off, let's take a look at the Morningstar equity analyst report. Very, very brief. Let's just talk about that. They actually say the fair value estimate to be 250. Yeah, I don't agree with that. Okay. They say that the economic moat is narrow, uncertainty being very high, ESG risk non-existent. Tesla's moat stems from two of our five moat sources: intangible assets and cost advantage. Company's strong brand cachet as a luxury automaker commands premium pricing, while its EV manufacturing expertise allows the company to make its vehicles cheaper than its competitors. Okay, now we're talking. The company clearly has a strong brand. That might be potentially being damaged right now for political reasons. I think that that's fairly non-material, but I digress. So, um, again, uncertainty very high. I agree with that. There is very high uncertainty. So, yeah, here's the deal. You see that over a majority of the time, and thank you, Seth Goldstein. Thank you for weighing in there. You see here for the majority of the period here, going back 5 years, the company is overvalued significantly, according to Morningstar. So this is the most recent shareholder deck from the Q4 earnings report dated January 29, 2025. How about this? This is their website right here. It's a robot, right? Okay. So let's talk about this company. In 2024, they had $7.1 billion of GAAP operating income. What's our market cap? Over 100 times that. Ugh, it makes me want to puke. More importantly here, free cash flow, 3.6 billion, but 2 billion in the fourth quarter. So that's 8 billion annualized. But even so, 8 billion, you're like 100 times, still just less than 100 billion times free cash flow on that annualized. You're like 200 times on that. Absurd levels of overvaluation. Now, would it be absurd if it was growing by 30 or 40% year over year? No, maybe not. This is a growth stock after all. But is it growing? Is it growing? That's the question. This is the kicker right here. 2025 will be a seminal year in Tesla's history as full self-driving supervised continues to rapidly improve with the aim of ultimately exceeding human levels of safety. So we'll eventually unlock an unsupervised full self-driving option for our customers in the robotaxi business. The robotaxi business, which we expect to begin launching later this year in parts of the US. They're behind in the robotaxi business, folks. Waymo is the market leader with Google. Okay. Does Tesla have the ability to compete? Well, what is Tesla's advantage in robotaxi? The hardware of the vehicle. What's their disadvantage? Google has the Google map, the spatial software, and the data of that. Tesla, I guess, has the has a, you know, counterpart to that. But we don't use it every day like we use Google Maps, do we? So it's hard to say. This is what I want to focus on, okay? Let's look at these quarterly numbers. These are quarterly numbers, unaudited. Quarterly numbers going back to the fourth quarter of 2023. So compared to the prior, this view over year column is this column over this column, right? Should be pretty simple, straightforward. So let's talk about this. This is an automaker, folks, and here's why. Because you have 20 billion of revenue from automotive versus 26 rounding up billion of total revenues. So, what is that? Pull up my calculator. I'm not sure if you can see this calculator, but I hope you can. 19,798 divided by 25,707. Okay, so 77% of their revenue is from auto sales. Okay, it's an automaker. All right. Now, again, the counterpoint to that is these numbers, the growth numbers. The energy generation and storage revenue has doubled year over year. Services and other revenue has seen great growth, 31%. Okay, so obviously, if those numbers continue into the foreseeable future, then these buckets are going to eclipse total automotive revenues. That's what's being priced in, guys. Okay. But what does that roughly correspond to? Roughly corresponds to company-wide revenues growing by 2% and gross profits going down and gross margins going down. This is not good. This is not good. 138 basis points over an entire point of gross margin going down over this quarter. You see gross margins steadily went up until they didn't. So what's going on here? What's going on here? Income from operations, well, operating expenses up 9%. So with gross profit going down and operating expenses going up, yeah, we're seeing a decrease in operating income. And our operating margin is down by 2 points, 6% margins. So, first off, 16.3% gross margins is not good. Okay. I want to see my high growth, high beta, volatile growth stock that I'm investing in to outperform the market. I want to see really strong gross margins. Just to give you a counterpoint, a really volatile growth stock that I actually like, Nvidia, their gross margins are like 77 or 80% right now. When a company has low gross margins, it means that they don't have strong pricing power. Pricing power is super relevant here. It's another reason I don't like automobile manufacturers. Cars do not have pricing power, okay? Now, you can have very strong car brands, but cars are somewhat commoditized, aren't they? Like, there's only so much more you can price your car versus the other kind. The switching costs of changing to a different car are very low for a consumer. Okay. So, I would expect an auto manufacturer to have low gross margins. In order to properly weight these growth numbers, I need to understand better what are the gross margins of those business segments. And I think in order to really take and assign strong growth, strong future potential to those as businesses, we have to understand the gross margin profile. I am going to assume that these businesses have higher gross margins, but I don't know. And if they do have higher gross margins, then what are our gross margins for autos? They're lower than that, right? Not good, not positive. Single digit operating margin, okay? 6.2% is low, but it's not different than what I would expect from a car maker. So adjusted EBITDA up 25% from the prior year, margin wise, up 19% EBITDA margin. So, okay, what are the adjustments they're making? Here's where it gets interesting. Let's take a look at this. Um, Earnings per share diluted. I don't really see growth happening here. Now, again, we're way down from this number to this number. I don't know what happened here. One thing I do understand is that the company has like Bitcoin on its balance sheet and stuff. You take a gain on those types of securities. Is that gap or non-gap attributable? I think you see how there's a big difference here. Um, I would have to investigate that a little bit more to understand it, but I'm already not liking what I'm seeing. Here's our annual numbers. Our automotive revenues have grown strongly, 27 billion to 77 billion. The hiccup we're seeing here, very slight. That's really strong growth in automotive sales. Clearly, the company has been gaining market share overall globally. Even more encouraging is 2 billion to over 10 billion in energy generation, 2.3 billion to 10 billion in services. I like this business. Okay, I like that business a lot. I'm an big energy guy. I've got energy investments. I've got beliefs in energy, um, from moral reasons. But let's take a look at this. Okay, this is not good. Okay, so revenues have total revenues obviously increased quite a bit, not year over year. Gross profit, however, peaked in 2022 and is down, like, what is that, 15%? So look at our gross margins. Our gross margins were higher in 2020 than now. In fact, they are even lower this year. And our operating margin was, 6% in 2020, but that peaked in 2022 as well. What is going on? I mean, look at this drop off in net income. Okay. So, folks, it's a car maker. Car makers are cyclical. Does this look like a non-cyclical business to you? Because it doesn't to me. Okay, let's look at this. Um, Total vehicle production was higher in the prior year quarter. They delivered a lot more in this quarter. So they must have had a lot of inventory that they sold. Got it. So that's why your gross margins are lower, assuming that that's true. Now you're starting to see the impact that interest rates might have. What's been, true across these timelines here. Well, interest rates have been higher for longer across all 5 of these quarters, right? And so uh, they've had to really feasibly or realistically, I would assume, cut deals to get their uh, vehicles sold. So that is probably an explanation for the lower gross margins. Even so, they had higher volumes and lower revenues, right, in this quarter for vehicles. So that doesn't look good to me. What does look good is this. I don't have a Tesla, and I've never charged a Tesla as a result. However, I assume that charging the Tesla at a supercharger station costs money, and that's flowing through into services revenue, driving some of the growth. This is a good business because it's energy infrastructure, which I like a lot. So that's interesting. That looks good. Um, and then here we have our annual numbers. Okay, so production went up 3.5 times from 2020 to 2024, down year over year. Total deliveries went up roughly the same, down year over year slightly. Our operating leasing is a good business. A little bit more predictable revenues. So that looks good. Our Tesla locations have gone up a lot. So that's fixed costs, right? Real estate costs. Um, this These numbers look good here. Okay, very interesting. So let's take a look at this. Um, Market share of Tesla vehicles by region. Look at these percentages here. Low single digits. You see how uh, widely fragmented the business is, how many different types of vehicles there are. Honestly, I'm a little surprised at how low these numbers are, and we don't see the global market share. But this right here, roughly a 4x, at least in US and maybe a little bit more in Europe and China, expansion in market share. So that is what is explaining these numbers here, right? Growing so much. We see that roughly corresponds. We had a 4x increase in market share, and the automotive revenues did not quite 4x, they 3x'd, because again, our prices have come down clearly. Okay. But That's how you're getting amazing returns on an automobile manufacturer, is just market share gains. However, what do we see? What do we see going on since Q1 2023 in the US and in Europe? That number's coming down. That number's coming down. China, I'm a bit surprised by those numbers because BYD, I understand, is a fierce competitor. Um, so I'm already 40 minutes into this video recording. So I really got to speed it up. But let's just take, I've never looked at this information in my life, by the way. Never looked at this. Artificial intelligence software and hardware. In Q4, we completed the deployment of Cortex, a 50,000 H100 training cluster at Gigafactory, Texas. Cortex helped enable V13 full self-driving supervised, which boasts major improvements in safety and comfort. So progress on Optimus hardware and software, including the latest generation hand robust locomotion and training on additional tasks. So what's interesting about Tesla is in these, we're already seeing multiple times the hype train filtering through this document here where they're saying, yeah, so this Optimus, I'm pretty sure Optimus is like the robot, the humanoid robot product that they're working on. Progress on Optimus hardware. We have ahead of planned pilot production in 2025. I mean, we are seemingly far out from that. Okay. And look, Elon Musk, I respect your business acumen and I respect what Tesla has done. I really do. But the and I also respect the emphasis on quality that the company has. I've ridden in a Tesla. I just feel like the stock multiple is elevated by so much forward looking promise with these new products like the Optimus hardware and full self driving and the robotaxi piece. And I don't doubt that they'll deliver on those things. It's just when so much of that is priced in right now and it keeps taking a while, it takes longer than the market expects to deliver. And furthermore, when they do deliver it and they don't rapidly gain market share and create a presence in that market, there's a lot of downside risk in the stock price if that's priced in. So again, we're talking about the merits of Tesla as an investment product, not a business. I mean, I'm very comfortable saying that Tesla is the best automaker, I would say. Like Tesla as a business, there's a lot more promise there than Volkswagen. You just your risk in losing money when you invest in this company, I would argue, is much higher on Tesla at the current level. Battery powertrain and manufacturing, energy generation and storage. The energy business achieved record deployments for both Powerwall and Megapack at a combined 11 gigawatts, resulting in a record gross profit in Q4. Okay, good. Material and other costs continue to come down at the Lathrop Megafactory. So here's our gross profit for energy and services. So in the most recent quarter, let's just put that right in the middle at 900 million. Remember our revenue for that, 900 million. What is energy and services and other? Actually, 5.9 billion revenue, and our gross profit is 900. See, that's still only about 16%, assuming that the they're bucketing those together. Okay. That doesn't seem very good. But objectively, I think the energy business is better, you know, than the vehicle. And of course, the ecosystem, it all works together. Again, energy storage deployments, that's interesting. Cost of goods sold per vehicle, all-time low. This is what Morningstar was talking about when they're talking about the moat, the narrow moat of their vehicles. If you can consistently manufacture your products at lower and lower costs, and then you either sell them at the same price or you lower the prices, which they've been lowering the prices, you can undercut your competitors and steal more market share. So that's the game plan that they're losing. This is a good graph. I like the fact that they're becoming more and more efficient. Another thing, I think the most positive aspect of Tesla stock and Tesla as a company is all this discourse around the tariffs. So a lot of these auto manufacturers, and the first that comes to mind particularly is Toyota, but a lot of auto manufacturers are based abroad, whether that be the Japanese autos, the Korean autos, or the German autos. And then, of course, we have our automakers here. It used to be American dominated, but it's a global industry with a few countries kind of taking the majority of the market share. Tariffs, wide ranging tariffs, um, raise the prices of autos that have a larger percentage of their supply chain, both in materials and manufacturing, based abroad. Whereas companies that, all other things being equal, have a higher percentage of their materials and manufacturing located domestically at the end market, um, in theory, should do better. So I actually think that tariffs, the wide ranging tariffs that we're seeing being discussed and or implemented right now, that is good and bad for Tesla, but all things being equal, it's good for Tesla because, uh, as far as I'm aware, Tesla has the ability, when it comes to buying one of their cars in America, they have the ability to manufacture all of that in America. Now, do all those components get manufactured in America? That I'm not aware of. And then, of course, you have the rare earth materials, lithium, most notably, I think, as well as what is our other, not aluminum, iron? Lithium ion batteries are like 1% lithium, but lithium's rare. Anyways, and then we see here Shanghai, Tesla lithium refinery. Not sure where that is. Tesla lithium on spodumene day. And then here's our 50,000 GPU training cluster. Very sexy. So, anyways, that was kind of a tangent. Tesla, given that they've invested so much over the last few years in manufacturing in the United States, that they're maybe better well positioned than other companies that don't have that. In fact, I saw a report. I think it was Volkswagen or BMW. They just said, "Yeah, we're going to eat the cost of these tariffs." They don't want to build more factories. They're probably making the bet that the tariffs don't last forever, which isn't a dumb bet, by the way. I like these graphs here. They visualize what we've discussed. Does that look like a company that's growing fast and worth 100 times earnings? I mean, you even see here vehicle deliveries have stalled. Operating cash flow, free cash flow gone nowhere. In fact, it's much lower. EBITDA gone nowhere. Okay, so look, I don't understand a lot about the Optimus and the self-drive, the energy storage, all these other things that they've got going on. I don't understand that. I'm just trying to look at based on where it is now and what the numbers are now. And what I look at these numbers, they don't justify a investment. There's a lot to like about this company. I think this bodes well right here. I think this looks good, but the gross margins aren't that good. Okay. This looks really good. This looks good, I think. There's your miles. The whole AI thing, yeah, they're putting their own AI, and there's all this. There's so much hype. There's so much hype driving this price, and hype cuts both ways. Hype can make you a lot of money in the stock market. It can also create a ton of downside risk, and we see that from here to here. Now, there's an argument to be made. Well, let's jump back to kind of a more technical analysis here. There's an argument to be made that here is a good entry point, right? let's use a candlestick chart for this. Okay. So let's take a look. I see a clear pattern here. Okay, so it's in this huge channel, right? Again, you know that my technical analysis is not very sophisticated. Look at how volatile it is. To me, what this looks like is we potentially have more down to go. Now, another way that you can look at this chart is to do this. Either way, we've broken down below that, have we not? One thing I would like to look at is 200-day SMA and a 200-week SMA. And then let's make sure our 200-week is a different color. So right where we're at here, it's really hard to see. Let's make this like a yellow or something. It's pretty hard to see the yellow, but we're basically right at the 200-week moving average, and we're below the 200-day. So to me, the technicals on this chart just look ghastly. It looks like there's downside here. I do want to qualify myself, and I mean, I've had other charts. Like yesterday, I'm looking at this Prologis chart. This isn't trading sideways. This is in an uptrend. Okay, so that's a positive for Tesla stock. It's in an uptrend. The Prologis was trading sideways, not in an uptrend, and it was kind of in the middle of a downward move within that channel. But because I'm already bullish on the stock, I'm saying, I have no heartburn entering here. So if you're bullish on a stock like Tesla, then you're probably not thinking this is too bad here. But I think there's a lot of danger in this price. There is upside because we're basically at the point of either we're going to capitulate further or it's just going to keep going. But think about the valuation that we're at now, 100 times earnings. We'll keep it simple, 100 times earnings. For it to return back up here, that's 200 times, right? Absurd. Furthermore, at an 800 billion market cap, we need 800 billion of liquidity. I know it's not that simple. It doesn't exactly work like that, but you get the point. It's a large cap stock. A lot of money needs to exchange hands to push the price to new all-time highs. I'm just not seeing it. So what are the risk factors with this stock? It's overpriced. It's has a poor and ghastly margin profile. It's in a race to the bottom on pricing. It's in a sector of the economy that's cyclical and tied to interest rates. And there's tons of downside factors with that. Furthermore, the competition in China, which I didn't even get to because I'm running out of time, BYD is, as far as I'm aware, is a threat, right? And China is a huge market, mind you, for vehicle. Way more people live there. So our auto market is important. When I look into the future, I see Tesla primarily as a dominator of the American auto market. And it has this closed loop system of the energy and everything. Yeah, that's all great. But I don't see how the multiple doesn't come down over time. I feel like the multiple will come down over time. And there's just a giant repricing that I see coming in the future. I could be wrong in the near term, in the immediate term, and I've definitely been wrong about this being a poor investment the last 5 years. My grade on this is a sell. I'm not comfortable owning the stock. I'm not comfortable. But if you already are in it and you're a believer in it and you really understand the future growth drivers in a way that you can quantify, then at best it's a hold. And we see here that the community here, whether that be the quant Wall Street or the Seeking Alpha analysts, more or less agree with that recommendation. However, given the way I see it, if I'm not willing to enter a position, period, then it might as well be a sell. So that's what it is, a sell. And I just think that there's further downside risk. It may look like a deal because it's here and you kind of look, you're like, oh, it's bouncing off this support line. Well, this chart here doesn't really match that, in my opinion. I'm sure I'll get a lot of comments. I'm very, very happy to engage. I just, I have a bias against automakers. This one, not only as an automaker, it's just so egregiously expensive of a stock and the growth rates do not match. So it has to be a sell. And yeah, that's where I'll leave it. So hopefully you found this entertaining, interesting, and useful. for your own analysis, and I welcome your counterpoints to my points. Please, I'd love to engage and hear from you. Be sure to check out my work on Seek and Alpha, which I'll link in the description. Yeah, I'll check in with you tomorrow with another video. So tune in. Thank you for watching. I appreciate all of my viewers deeply. But anyways, until next time, I'm going to sign off now, but this has been fun and hopefully you found it useful. You have a good day and I'll talk to you tomorrow.